Good afternoon, everyone, and welcome to today's webinar on how to create a business plan. And this webinar is part of our series where we work with universities on our university startup development program. So as I was saying earlier, this webinar is part of the University Startup Development webinar series. So I'd like to welcome everyone this afternoon for joining us, and hopefully you learn a lot today. So before we begin, just a couple of reminders that we are holding our next University Startups Demo Day on October 16 and 17, and we are highlighting university startups as well as IP that are submitting to us for this event. The deadline is actually tomorrow, so if you're interested in submitting IP or startups for consideration for the demo day, all you need to do is go to nset2.org and submit your IP and startups by tomorrow before midnight. So that way we can forward them to our corporate selection committee to be ranked and scored. And the startups getting the highest scores will get presentation slots. And for IP, it'll be featured in the IP book. And as part of the demo day and the submission process, the startups and the IP will also be funneled into our development program, and we'll talk a little bit more about that later. So as I mentioned, this is a series. So if you're registered for this webinar, you actually don't have to register for the succeeding ones. We have a few lined up this month, and we're adding more. So as I mentioned earlier, if you're already registered for this webinar, you'll get reminders for each one. So coming up next week is how to connect with angel investors. We hope that you and your colleagues can join that. And then after that, it's how to attract venture capital and market validation. After then on September 20th is how faculty can take IP and building a university startup. So basically, this webinar series is focuses more on those who are interested in building their own companies and the components that it takes to build a startup. So before we move forward, a couple of housekeeping questions. We will have Q&A at the end, and all you need to do is type your questions in the questions box of your GoToWebinar control panel. And when you do that, we'll queue it up, and hopefully we get to your question before time runs out this afternoon. This session is being recorded, and the slides will be made available 24 to 48 hours after the webinar concludes. So if you have colleagues that are registered for this webinar but missed the webinar, you can let them know that the slides and video will be made available so they can watch it when at their leisure. However, always check your emails because we do send out notices as to the availability or updates on the webinar series. So you'll be receiving updates from us as well. Moving forward, just a quick overview of the webinar agenda today. So we, aside from how to create a business plan, which is our main, I would say our main event, we'll also do a recap on the background of the startup development program. We did a webinar last week about an overview about the program, but if you missed that, our speakers will cover that as well. And as I mentioned earlier, that this series is basically covers many aspects of what it takes or what you need in order to create a university startup. So, and after that, we'll have next steps. What do you need to do in order to participate in the startup development program? And we'll also have Q&A at the end. All right. So without further ado, I will now introduce our speakers for today. So speaking today are, two very knowledgeable people on startups, university startups, and how to create startups. Our first speaker today is NCET2's our executive director. He's a former Securities and Exchange Commission attorney, Tony Stanko, and he'll be followed by Dr. Bob He's Rick. He's an NSET 2 Startup Development Officer. He's also a Bridgestone Chair of International Marketing and the Associate Dean of Graduate and International Programs at Kent State University. So, without further ado, I will turn it over now to Tony to start off today's session.
Okay, thank you very much, Rhea. Welcome, everybody. I'm going to talk a little bit about the background of the Startup Development Program. So, Rhea, next slide. So, this is actually an outgrowth of a congressional ask. Congress contacted us about over 2.5 years ago now, I guess, in 2015, and they were looking for ways to commercialize the $137 billion of federally funded R&D at universities and federal labs. And so specifically, they wanted to talk to our corporate members, our Fortune 500 members, to see if they had any ideas. And, they definitely said they had some ideas. So we created a congressional commercialization summit. And the corporates, we had about 25 corporates come in, and Congress came in, the Obama White House came in, and we talked about different models. And one of the things that came out of that was, the model I'll show you in a second here. And we vetted that. We had congressional briefings. We did some early pilots with the demo day, but now we're into the the real meat of it, which is the startup development piece. So that's what this is all about. So Rhea, do you want to go to the next slide, please? So I'm not going to spend a lot of time on this slide, but this is the model. So the corporates, put together a subcommittee and came up with this model. We took it to Silicon Valley, talked to angels, VCs, and universities there. Same in New York, and then again in Philadelphia before we started congressional briefings. It's pretty involved, but there's webinars and things like that describe this a little bit more. So we're not going to spend time on this today. Go on. Rhea, next slide, please. So the Startup Development Program is a way to help university faculty, researchers, and students create, develop, and fund market-aligned university startups. And that's the key piece. They're market-aligned in the sense that it's not a technology push program, which is generally what everybody's doing. The corporates came up with a market pull type of model where they will, acting as either a buyer or a surrogate for the IPO market, will tell everybody, and that includes the researchers, the universities, the angels, the VCs, the SBIR program, what they're looking for as a way to kind of see if there's a market for the startup at the end of the process. We've, as part of this program, have assembled a pretty strong team of startup development officers like Bob, who's going to be speaking on business plans today. They will be doing some webinars in future weeks, talking about different parts of the ecosystem. But the startup development officers are really the people that will help you market align and develop and fund your startup. Maria? For the students and researchers, faculty on the call, the point of the program here is to help help you develop into senior or experienced management teams by working with the startup development officers that are more experienced. Basically, they'll help you start your company, help you with business plans, proof of concept, prototyping, and early product development, which, for people that are familiar with the terminology, that's called the valley of death. Usually this is where the research kind of dies after it comes out of the lab. It doesn't get to product development. So this is, part of the startups get through that. We call them commercialization experiments in a sense because they're like R&D experiments. There's a lot of things that you need to try. Everybody thinks they're going to work, but the reality is the science doesn't cooperate, or the market doesn't cooperate, or something doesn't work out, and things don't. The failure rate is almost as high as the research experiment failure rate. But the idea here is to really have the experiments run, get to the other side, and double down on the ones that succeed. So what's really helpful for researchers that are looking to work for Fortune 500 is this is a way to kind of show your entrepreneurial skills to the Fortune 500. So even if the company doesn't succeed, you'll end the consolation prize is working for a Fortune 500 if that's where you want it to go, because they're looking for these entrepreneurial researchers, and you just have a leg up on any regular researcher that just comes there with lab skills. All right, so next. Benefits for the researchers, again, access to the professional startup development officers to help you create, develop, and fund your startup. For the significant market impact. And for the graduated students, again, you get to work in startups, and either that startup succeeds and you end up working for Fortune 500 because they buy the startup, or you work for the Fortune 500 if that's where you're going, because the company doesn't succeed, but you put it on your resume and you get hired because of the researcher entrepreneur experience. All right, next. All right, so with that, I'm going to pass it over to Bob.
Thanks, Tony. It's really a pleasure to be with you all and talk about one of my favorite topics, creating a business plan. We're going to just give a highlight and an overview of a typical business plan, but it's really an extensive document. Usually for the first time, you'll probably put in about 30 hours creating it, but the rewards of that are exceptional in terms of understanding exactly what your business is all about, or will be about in terms if you're at the technology stage, as well as what benefits you're going to get from it. What are these benefits? One, the biggest reason people write a business plan is to obtain capital. So of the probably over 750 business plans I've either written, evaluated, or been a part of, the majority of those were to obtain capital, either at the technology stage, or I'm trying to get money to move forward, or at the commercialization stage, or even at later stages when I'm really trying to grow my company. But out of that, also, you get several other things that are benefits when you go through this process. One, you really understand your business, and that's important because when you're making your presentations for a capital raise, the investors have gone through this many, many times, and they can see whether or not you truly understand your business. Number two, it gives you a benchmark of which to compare how good you've done. Now, this is a part of it when I create my own companies I don't like very well, because you are doing what we call pro forma, or future forecasts of revenue and costs. But the reality is this is what happens during that time, when that time period comes to bear. So you're going to have what I call a opportunity to see how well you did, and then be able to address those problems. And three, and I'm not sure if these are in any important order except raising capital, you are able to see when you need resources, and planning the resources, particularly, for example, when you're growing your company, when do I hire that next VP or that next high-level people that are going to cost me some significant dollars and or equity give up. And so it gives you a chance to understand I got to have them early enough to be effective, and so I don't have problems, but not too early that I have to pay salaries for something I don't need. So with that, let's go over a typical business plan. Now, there's many formats you can use. I like this one particularly just because it flows logically for a reader. And remember, your goal here is to obtain money, but it has basically 9 sections. Some of you may not have a 9-section business plan if we'd go back to page 10. But these are the first 4 sections of the business plan. So, Rhea, would you go back to the previous slide on page 10? Okay, so you'll see we have 3 sections. Section 1, Section 2, and I'll talk about Section 3 in a little bit. Section 1 is really just the intro to the business plan, and obviously has a title page. I recommend below that title page, you put this particular statement at the end of it. It obviously gives the company information and all those kinds of things. But the critical issue is this sentence at the bottom. It says, this is business plan, and put a number in, a very low number, of course, number something, the confidential business plan number. So this is confidential business plan, and then put in a number. Any number between 1 and 4 is good. You don't want a high number because then immediately the investor says, well, what happened to the other 9? So you want to use probably 1 through 4, and this gives you a business plan tracking system too that you're going to want to do because you're going to want to follow up. Now, confidential here is sort of an unwritten agreement between you and the receiver of the business plan that this is a confidential situation. You are not going to get any investor that I know of to sign a confidentiality agreement. So this is the best thing for you on that. Let me also assure you, however, from an investor's point of view, because I'm on that side of the equation as well, we would never violate that trust you've given us because we have to have our own reputations, which says we're going to honor that confidentiality because we want more deals and a deal flow so that we're not going to get a reputation for being one who would violate that confidentiality. But we won't sign a confidentiality agreement because many people, if we're working in a particular firm like a venture capital firm, are going to review this plan as well as ourselves. The third part of this, that you have a table of contents, obviously, just like any book. I'm not going through that, but is the executive summary. I want to tell you this is the most critical document you'll ever write in your life in terms of obtaining capital. We turn to the next page. On page 11, you'll see an example of an executive summary. Now, this is for LLC, Mercury Biomed. They're all basically the same. And they focus on this executive summary. So you may have a 45-page business plan plus appendices or whatever. You've got to give this 45 pages down to 2 pages. Why 2 pages? This is just sort of the nomenclature that's been come in the industry. I don't have any logic for it, but it's what venture capitalists and private investors expect is a 2-page business plan, a 2-page executive summary. What do you focus on in this executive summary? You want to remember there's 3 things investors use to determine whether or not they want to invest in your company. Number 1, the management team. There's one venture capitalist, I think he's raising now his 8th fund, sometimes called the daddy of venture capital. But he said you got to bet on the jockey, not the horse. In other words, you bet on the team, not the idea. And we can go back in history and you can recall yourselves many times where one technology may even be superior to another technology, and yet because of the team, the technology that's of lesser capabilities or quality actually wins in terms of the marketplace. So you want to talk significantly about the team. Number 2 is the idea. So you need to talk about exactly what your idea is and how it's positioned in the marketplace. In other words, what is your competitive advantage, as Porter would call it, or what I like to call unique selling propositions. So I want to compare my technology or where my technology is going if I'm at an earlier stage with all the technologies in the marketplace that satisfy that need. Now, this means you want to look very broadly on that and then come down with perhaps 3 to 5 that really do satisfy the need, and then compare that in your business plan and then summarize it in your executive summary in terms of why are you unique and different. Investors tend to like technology that's unique and different and that has, the second part of this, a large market. Because large markets, they know, actually have the probability of having a large return on investment because of your revenues you're going to get from that. So the other part of this in terms of the idea is what market are you going to address and how big is it? So you got the idea, you got the competition, you got the unique differences that you have, and you're going to appeal to this market, which is at this size now and has a growth rate of whatever, and all that in your business plan will be documented in terms of references to whatever references you have. And people really look carefully at that documentation. So now what do we have? We've talked about the people, we've talked about the idea, and the third thing, obviously, and really in order, if you do any surveys of these people, I have a hard time sometimes understanding this, but the third thing is the returns. So they want a return. So you'll have a financial statement, which we'll talk about in a minute, that you got to summarize in terms of a very short financial statement. Now, if you look at the bottom of this page, you'll see we go out from 2015 to 2021. You need to go out at least 5 years, and all of your financial statements, which we call pro forma financial statements, which means they are forecasted and not actual, have to go out for 5 years. Why is that? Well, part of it was defined, even though we know years 4 and 5 are very inaccurate, because obviously the further out you go, the less the accuracy is because of the programs that a lot of the angel groups use, and we've had seminars on them, our angel networks, are based on a 5-year pro forma. Even venture capitalists, for some reason, want to go out 5 years. In some cases, if you're a very high-tech technology and you're at a very, very early stage, so you're actually getting money for the technology refinement and perhaps not even getting to market, then you may go out even further. But you definitely want to go out as far as you can until you know the venture will positively cash flow. What does that mean? Positively cash flow is the most important time ever in your venture, because that means that your company is covering all of its costs of operations by the revenue it receives. And if you remember, revenue minus cost equals profits. So I am then showing a profit for the first time. Now that doesn't mean I've recouped all my costs, but in terms of that increment of time, that year, that month, whenever it occurs, I have covered all my operational costs for that time with my revenue. So you want to go out at least 5 years, or out until you know you're going to positively cash flow. So if I have a high-tech product and I'm going to be in development for a long period of time, these may go out very simplified version, because all you need is the simple parts, i.e. revenue, costs, and that gives you gross margin minus operating expenses, gives you profit before taxes minus taxes. So those 5 elements you need particularly need to go out quite a few number of years. Now, if we turn to the next page, you'll see the last part of this plan, page 12. You'll see that this has gotten nice, the solution to the problem they've addressed, and then the founders, etc. So they have everything here. And let me talk just a little bit about the problem. This is what I call the hook. Now, you can put the hook in the front or the back. These people tend to do it in the back. I sort of like it in the front, because what you're trying to get across to these people is that here is a significant problem that needs solving. And obviously, the more significant a problem, the more the investor can relate to that problem, the higher the probability is you're going to get some capital. And so this is the problem. It's unique. It's critical. And here is the solution I'm going to have to solve that problem. And then we're going to do that because we have this team, and then we have these results that we showed on the first page. Now, why is all this important? It's important, and why this executive summary is such an important document and why I took so much time on it is many angel investors will only, and venture capitalists will only take that as a precursor before the business plan. So in other words, this is the screen they use to see if they want to go through the task of analyzing a business plan of significant more pages, sometimes 40, 50, 60, add in appendices, it can get up even higher than that. So you really want to make this document very, very, very concise, very well written, and right to the point, and feature the 3 things that they're most interested in. The team, the entrepreneurial team that's going to do this, the idea and its uniqueness, along with the size of the market, and finally, the third thing is the financial returns we have. So that is the executive summary. Now let's go to the back to the first page, and we'll go on in the section 2. Section 2 has 4 areas which is very important. One of these areas is this whole thing about the description of the business. This is very clear cut. We talk about the venture, we talk about the industry, and we talk about the mission statement of our company. Now, I used to not talk about this mission statement when I would talk about business plans all over the world, but I think it's very important now. We are now sort of driven by this concept of mission statements, and if you like, you can email in or in the NCAT too, and I'll send you some summary mission statements of a lot of companies. I've studied those both here and the European Union. And but people sort of like a company that has a mission statement. So it's not something you want to slough over. And then you want to talk about a business model. Does your idea and your business really radically impact the industry as it operates today? Section 2 is a very critical document, and one of the ones that are probably the most frustrating to create because it's all data. So I got to go into the homework and I got to find out who are my competitors. And I need, again, at the appendice, I should list all the competitors that are satisfying the need. I need to select 5 or 6 of these in terms of that are more closely related to what I'm going to do. And then I got to analyze them in respect to what my technology is going to do to satisfy the need. Hopefully, out of that, you'll come up with 3 to 5 unique selling propositions that makes your idea, your technology better than anything presently on the market. And then I got to switch to the second part, and I got to say, well, what market and how big is it? So then I got to look at the market and make a determination of that. Most of this is done if you're a business-to-business company through what we call NAICS code, NAIC, and then you can convert our NAICS code, which is a number assigned to a particular industry segment, into other NAICS codes. For example, they're called differently, but in China it's SIC code, in Korea it's SIC code, and the European Union has its own code. So you can actually look at this in a global fashion too, if you so desire, in terms of the what industry you're in. So that's going to be talked about in the type of industry, as well as the industry you're selling to, which has a different NAICS code, which again can be converted to any of the others. So you need, and then you need to find out the growth rate of that market, and usually trade journals and things like that can provide that. So this is all, and then you really know how you're going to forecast out, and then how you're discounting that back in terms of what the revenues in the future mean in today's terms when you ask for your investment, and therefore what percent of the company you're going to have to relinquish to the investor in order to get the capital that you need to grow. So that is probably one of the most time-consuming sections. That's where you may want to use a graduate student from some college to go in and do the library. You may want to pay some librarian to help you with that. You still want to be involved in it, because I want to tell you, when you go up to make the presentation before a private individual, high net worth individual, before an angel network, an angel fund, and or venture capitalist, they're going to be able to tell if you know what you're talking about very, very quickly. The third part is what we call the technology plan. This is very, very, very important. Most of you will have a technology plan, because you're going to have technology you want to take to the marketplace. You'll need to talk about your technology versus technology on the market. You're going to want to briefly describe your patent, and then your patent should be, or patent pending, either one it is. The patent itself should be in your appendix, along with some other things. We now have statistics in the appendix. We now have the patent in the appendix. And we'll have one other thing when we get to organizational plan, so that people really understand why your technology is different, unique, etc. It's protected, and it's going to meet the requirements of the marketplace. Point 4 is, chart 4 is the marketing plan. Now this is really a critical document as well, because you need to end this with the thing at the bottom of this chart, as you see, sales for the first 5 years. That's the goal of this plan. And once you have that, then it segues over nicely to our next section, the financial plan. So I got to show the reader of the plan, particularly the investor, what is my market segment, what is my target segment I'm going after, and how am I going after. So if we go to the next slide, you'll see what I call market segmentation. So market segmentation, as you see, depends on, and this is out of one of my books, as almost all this stuff is, you can see that we're talking about 3 different markets. We've got a B2C market, which is a consumer market. We've got a B2B market, which is the industrial market. And then we got a B2G market, which is the government market. So we got 3 different markets. I only want to briefly talk in our time here about the middle one, because that's the one most of you will be going to. Business to an industry, B2B market. So we have 6 basic ways we can segment our market. In other words, take from a whole group, so we have this big, large market, and then we're going to narrow it down to the market we're going after. So let's just say we're into the hospital. We have a medical technology that we're going to shoot at the hospitals. So our demographic then is hospitals in general, and then in specific, it may be according to the number of beds. Now, you'll be amazed if you've never gotten involved with this, the amount of counting that's done. And the industry that has probably the most data of any industry in the United States, at least, and probably any industry in the world, I know it is in China, for the country of China, is the medical industry. It is tremendously data laden. That's why we talk about big data now, which is such a hot topic, and those kinds of things. So most of all this data is published. So you just got to get what we call the NAICS code here in the United States, NAIC code, and for hospitals, go into that code and you get all kinds of information on hospitals by size, etc., and the total number of hospitals listed by geographic area in the entire United States. That's public information. And you want to remember, in our country, in the United States, public information, because of the Freedom of Information Act, says public information, any data collected by the government, is open to anyone in the world. It's public information. So that is accessible to you. And then if you want to get it more refined, you may have to pay some money for some agency that refines that data, but you can get the access to any single data you want that's collected by any government, state, local, or federal in the United States. Obviously, demographic segmentation flows nicely into region of the country or regional segmentation. And as I said, we're in the hospitals, just as an example. So I can find out that in Cleveland, Ohio, there are what hospitals they are and where they are. And then I could go further and find out how many beds they have if I'm worried about size or whatever other factor I want to use for that. And so now I have a nice part. So the two most widely used segmentation criteria are these top two. Why? Because there's published data on them. So we really want to get that data and have it apparent so that I know what's the size of my market. And when I create my marketing plan, which we'll get to in a minute, then I know exactly who I'm going to target. And why I want to know that, so that I know that when I start my company, start my venture, once my technology is to that point, and if we need FDA approval, approved by the FDA, I know exactly where I'm going to start my venture. So we had a product that was into the hospital market, and so we picked, because we were located in Cleveland, Ohio, this was some years ago, we picked three of the hospitals in Cleveland, Ohio. Cleveland Clinic, we wanted that because obviously the Cleveland Clinic not only is ranked as the #1 hospital in various hospital segments, but it's close by. We also picked University Hospitals, another good hospital, but not highly ranked as Cleveland Clinic. And we picked a smaller hospital so that we would know that the first year we're totally going to focus all of our efforts, because it was an enterprise solution, on those three hospitals. So that's demographic and geographic segmentation. Now, there's 4 other segmentations I'm not going to take a lot of time on because they're not used as extensively. Psychological, with degree of industrial leadership. We used that a little bit, didn't we, in my example, because we picked the Cleveland Clinic. And we know that if the Cleveland Clinic's going to take it, we're going to say that to all of our future sales, all of our other target market people. Next slide. We'll see the last 3 segmentation characteristics here in terms of this market segmentation. The one I like the best of this, there's volume, which we used by number of beds. The controllable marketing element, that's just in my book because I want to cover everything so nobody says I left out anything. But the one I really like is the benefits. In other words, the reason I like it is not so much it may not define for me what markets I'm going after. The reason I like it is I want to make sure I am positioning my technology to cover and deliver the benefits that the target market wants. And I really like that because it's a very simple model. If somebody has a need and they want these benefits to satisfy that need, and I give them that, I'm going to win. So these are very general statements of benefits: dependability, reliability, efficiency of operation, etc. But you really want to take some time, maybe go out and talk to 20 potential customers. It's amazing that in this kind of game, as long as there's not a great divergence in the sample and the universe, that takes very few individuals or companies or hospitals to be statistically valid, and find out what benefits, when you buy a product to fulfill that need, what benefits do you want to have specifically? And that becomes the goal of developing your technology to satisfy, to deliver those benefits and satisfy the need there is. So we now have the market we're going to target. Then we can turn to the next slide and I'll show you how we're going to target that through what we call the marketing mix. On the next page 16. On the marketing mix, you'll see very soon, I'm sure, what we have. We have 4 basic things we control. Number 1, we control the product or the technology. And these are just some issues you want to think about, general issues, quality, assortment, guarantee, service, package, those kinds of things. And that's a part of this whole marketing mix. So you got to have your product that's unique. You probably want to give some kind of warranty or guarantee, and you need to package it in some form. Obviously, consumer B2C markets are more dependent upon packaging than the B2B markets. But the B2B markets have it as well, and if you ever want, we can chat on the phone. I'll share you some stories. The price is the next variable, and that is a really important one, and one that's probably the worst done by startups and SMEs, small and medium-sized enterprises. For some reason, we get in our thinking process that price is going to be the turning variable. And I want to tell you that it's probably product more than price that makes the decision for someone to purchase your particular technology. But price is important. I want you to think of price in terms of the 3 C's of pricing: the cost that you're going to have, the consumer that you're going to sell to, and the competition and the price. And if you use that, you can probably come up with a price that makes some sense. Then we got to look about its distribution. And then, of course, the last thing is one of the more fun parts of the marketing plan is the promotion mix, how I'm going to make people aware of what I have to do. So that ends our section 4, the marketing plan, which is very important. And that ends with sales for the first 5 years. So if we turn to the next page, page 17, you'll see that we're now into section 6 of the business plan, which is the financial plan. So if we could turn to page 17, we're in the financial plan. Here we are. So instead of looking at this, Rhea, if you go to page 18, but I just wanted to show you sequential how we're going through this. Page 18, you see the financial statements we need to have. These are the financial statements in any good business plan that you'll have. You have a sources and uses of funds statement, which means this is the money I need and this is where it's going to come from. Hopefully the investor is going to provide a significant amount of the uses of money. All the rest of the financial statements are general statements you'll see by every single company operating. These are what we're going to report out. That gives us the difference between what we projected and what we happened. But we have an income statement. We call it pro forma because it's forecasted. We have a 5-year summary first because we will go out at least 5 years. Then we go break it down by first year by month, second year by quarter, third year by quarter. We take that, once we created that pro forma income statement segue of those 3 statements, that easily converts, if you're using the right computer's software, into what we call the cash flow statements. The cash flow statements then have the same kind of sequencing, 5-year summary, first year by month, second year by quarter. And this is out of the cash flow statements where we get what? That great critical point, which is called positive cash flow, where our revenues are greater than the costs, and therefore we're financing our company internally instead of externally. And finally, we have the pro forma balance sheets. Those are just at the end of the year. These really have no meaning at the start of a company. These are only meaningful when we have some assets. This is measuring of assets. So they're not looked at very carefully at all by the investor, but you need to have them there for completion. We're at 5 years, so we got a 5-year pro forma balance sheet. Large companies that have been involved for a while are not growing are measured by assets, and that's where the balance sheets become more important, whereas startup companies and high growth companies, which you will be, hopefully, are measured by income statements. So out of these, what's the most critical statement that the investor, and this is the first place they're going to turn if you've bought them through screening through the executive summary, they're going to look first at the 5-year pro forma income statement. They're secondly going to look at the 5-year pro forma cash flow statement. The third statement they're going to look at is the sources and uses of funds statement. So these have to be good, they have to be complete, they have to be done in a way that the relationships between the three statements, and that's the way you're going to manage your business anyway, are well known and understood. And that's where you're going to, if you get to the point, hopefully you all will, to make it the form of the presentation to the investor, this is where you want to focus a lot of your time in the presentation. The area you're going to make is you're going to focus because you feel more comfortable with on the technology. This is what they want to understand. The second thing they want to understand is how you're going to achieve that, because the first line of the pro forma income statement is revenue. Revenue comes from the marketing plan. That's the sales, and we said sales for the first 5 years. If we go on then to the other 4 sections of the plan, read page 19, you see we're on the production plan. Sometimes, hopefully most of you will outsource this. So this really becomes an outsourcing plan. But if you are going to produce, then you're going to want to know all the production of material. I don't see any reason at the startup you want to raise capital to produce when you can outsource that and then sort of assemble as you need to. But that's, of course, your decision. 7 is the organizational plan. Here's where you describe the management team. And here's where you refer to one of the most important documents that's back in your appendice, and that is each member of the management team needs to have their resume in the business plan, and that occurs in the appendices that are the final part of this business plan, and you really need that. If you have some advisors and on your advisory board, most of the time they will not want to share their resume for the business plan, but at least you can put a summary description of them both here in the original plan as well as in the appendices if you need to enlarge it. Here's where you're going to want to put the type of company you're going to form. Most of you will probably form LLCs, which is a standard form. If you have investors outside the U.S., you're going to have an SC versus an LLC, because an LLC does not allow for investors outside the U.S. Or now you can actually form, without a significant problem, a corporation, particularly if you're farming in the state of Delaware, so you may want to consider that as well. If you ever take your company public, or probably when you deal with venture capitalists, you're probably going to have to be a corporation. But again, if you start out as an LLC and or an SC, then you can easily convert that just through filing, which is not a significant procedure nor of significant costs. So the organizational plan, and then we have, the 8.0 is the operational plan, where we have a description of the company's operations and flow of orders, very short, probably 1 page. And then we have to conclude. You remember, any novel you have has an opening, an input, and then a closing. So you have to have some summary or conclusion just to make a plan. That's, again, very short, half a page, maybe a page at the most, to conclude your plan. So that's what we have in terms of our business plan. It's a hard document to create for the first time. The section that's going to take you probably the most time, because we have computer software to do the financial plans, both income statement and cash flow statement, is the section 2 in terms of the competitive analysis and the description of the industry, and section 4, the marketing plan, because here's where you got to think about who's my target market, why am I going to achieve that, how am I going to reach them, and then come out with my 5-year sales forecast. So I hope you get a feel for this business plan. It's a document you're going to use. It's a document that's needed. In fact, a venture capitalist will not see you. Most banks will not see you. Most angel investors individually or in groups will not see you without having a business plan to present to them. So I'm open for any Q&A or any for Tony. So good luck and have a good, fun time creating your first, or maybe not your first, but your business plan.
Thank you, Bob. We do have a few questions lined up. So maybe we can start with the first one. Okay, our first question is, how important is the business plan for angels and VCs? I think you mentioned something like that earlier, but maybe you can expand a little.
I sure can. Sure. I want to, all the venture capitalists, and I often do they always have consultants, either internally or they bring them in from the outside. And there's 3 things they're interested in. One, the technology, which I usually don't address. It's usually somebody that's a technology expert. The second one is the competition and the positioning of the technology in the marketplace and the size of the market. And that's what I do as a consultant. And as an angel investor myself and the other angel groups that I'm a part of, we always require a business plan. So in other words, if you don't have a business plan, you're not going to get in front of these people. Banks usually have the same kind of requirement. That's debt financing. Debt financing says you have to have an asset. Most of you at startup will not have an asset. Perhaps your patent is worth something, and your body is only worth $1.98 in chemicals. So, banks are asset-based lenders, so you're probably not, you still need one, although it's not as important for debt financing.
All right, our next question is, investors tell them that the business will pilot on first contact with the customer. So what's the point of spending time putting together a business plan?
Well, that's a good question. I know that's one of those things that are talked about all the time. And is a business plan, should it be done or should it not? First of all, unless you have some investors, and even if you get family and friends to invest in your company, they have the right to see what your plan is, what you think you're going to do. So I think it's just important in order to get the contacts and be able to deliver and talk about what you want to do. Obviously, there's no question about it. A sale is not made on a business plan, so you're going to have to make contacts with the customer. But you probably won't have the opportunity to make contacts with a customer if you don't have a business plan because you don't have the capital. Now, if you don't need any capital, then you can do what you want. I still highly recommend, even if you don't need capital, which I said is one of the primary reasons for writing a business plan, I still think a business plan is good discipline to have you think through what you're going to do, when you need resources, what you expect, when you expect to positively cash flow and therefore internally fund your business. And you can't get any of that without having a business plan to do it. So I highly recommend the business plan, regardless of some of the myths that are floating around out there about our business plans obsolete. I've seen articles like that. I've seen articles, why spend your time on business plans, which is part of your question. I may be in a different world, but my world says the business plan is important. And as an investor myself, I'll talk to you in general. We can have a beverage or some food, but I'm not going to look at anything you want until I see a business plan, because I have nothing to put my money in to.
Yeah, maybe Bob, I could say a couple words on this too. So, I think the point is really not the plan itself. It's the thought process and the planning to get to the business plan. So I think that's what investors and people are looking for. Have you thought it through? Have you considered all the points that are on the business plan? And that's how you show you have. So I think the question is a good one. And I think there is a controversy, but the thinking behind the business plan, regardless of whether you end up with a business plan or you show anybody a business plan, is really the point of it. Like, are there any logical flaws in what you're doing? Is the competition being addressed? Is the product, saleable to customers at a proper price point? Is the market there? All these considerations have to be addressed in a good business model, and so the business plan just allows you to really be coherent.
And I agree, Tony.
All right, we have a next question here. How does a seasoned serial entrepreneur become an SDO? So, Tony, this is probably for you.
Okay, yeah, probably is. All right, so the Startup Development Officer, exclusive group. So it's not easy to get in. I think we're doing like 1 in 5 that are requesting. We're kind of bringing in. You have to be in one of 3 categories. So you're either a serial entrepreneur, and it sounds like you are here. So that could work as long as you have startups that have been successful. The other is you have to be an angel investor, and again, it's how well you're doing. And the third group is an ex-corporate executive, so somebody that's worked at a Fortune 500 is the other category that we look to have a startup development officer. All right, so there is a bit of a process. I think going forward it'll be more refined, but right now we take resumes and references and just see who in the community is the best of the best to help the students, the faculty, the researchers of things. Basically, from the lab to a Fortune 500 company, though it could also be from the lab to an IPO if the company is that good. All right. Bob, did you have anything on this or?
No, I think you did well, Tony. I'll take a pass on this one.
Okay, great. Thanks.
Okay, our next question is what metrics do you use for screening and project selection? This is probably also for the SDO.
Yeah, these have been great questions, tough ones too. I really like that you really put thought into this. I think to me there's two key dimensions, and what I can and we can send you some information on it, Rhea, if you just email in or however Rhea does this. I call it an opportunity assessment plan, and we're using that with a fund we have here at the university. And this is our first stage. So when you come up with your technology that you have, the first thing to me you want to look at is how does my technology compare to the technology in the market? So one thing in terms of that project selection is, do I have anything unique? Now I know all of us think what our idea is the most unique. Nobody has done it before. It's the only thing on the market and all those kinds of things. And I really wish that was true, because I've been had to show myself and then have to not do it. But that the idea I had really has been done several different ways and several different times, and I have nothing unique or different. So you want to look at your technology, and one screening criteria: do I have 3 to 5 things that are unique? Now, interesting, you think, well, why only 3 to 5? Probably you won't have anything more than 3 to 5, but more importantly, this is what you're going to focus on. And obviously, if I have 3 to 5 uniquenesses, that's going to be the heartbeat of any kind of messaging I do later on. The second thing is there a market for it? Because we often have a lot of technologies in their early stages, and even as they move through the pipeline, that have no market. So to me, it's important for for you as a scientist or your inventors, or if you're a development officer, for them to say, this is the market, I think we'll have some uses for this particular technology. And then you're going to need to go in, and if it's a B2B technology, then you're going to need to get an ACE code. If it's a B2C technology, then you're going to get some demographics of the consuming population in terms of the market. And the market's got to be a significant size, and you obviously want a market that's growing, because a market that's decreasing obviously is going to continue to decrease for a period of time. And secondly, when you enter that kind of market, it's very, very difficult, because you're not just entering a growing market. So that to me is the two most important metrics. Well, how am I unique versus everything presently on the market? And number two is what's the size of the market, and how fast is it growing?
Okay, our next question. Oh, sorry. Sorry, Bob, were you done?
No.
Oh, okay. How would you build a strong team without having initial seed capital?
Oh, wow. I'll tell you, Rhea, we're going to have to get to softer questions. That's a great question, too. I'll just share you with my experience. That is a very, very, very difficult thing. I think what you're going to have to do is get people who are willing to be sort of on the advisory board. Maybe you'll have to fulfill some of the needs by a consultant, these kinds of things. But what you got to be able to do is have a business plan. I'll tell you how in one venture we created in Boston when I was at an university up there, is we had a great idea for a gas permeable contact lens. So the scientists and I knew we needed to have some other people on our team. So we actually, went to them and said, listen, we'd like to use you in our business plan. We will not use your name if you don't want. If you come on board, then we have a pot of capital set aside that you will have. And we always want, if you're going to offer capital to entice people, you want to have it invested or come to bear in at least a 3-year period. So in other words, if you say, we'll have you have 3% of the company, but you're going to get it in increments of 1% the first year, 1% the second year, and 3% the third year, or 1% the third year for a total of 3%, so that you keep them, you have them committed for at least 3-year period of time. Once the capital is raised, then of course you can have a salary along with it. So you're going to have to do the same job of convincing people for your team as you are going to have to do to convince an investor to invest in your company. And with that, you're probably going to be able to, at least because they're not putting their name on the document, you can at least have interest and use their resume as someone who is potentially you're going to be a member of your team. Investors don't need the full team formed. They just need a description of the capabilities you have to call that you're going to have on your team in order to be a success. So as long as you have the description of the capabilities needed, and you might have a candidate or two for that without naming, then you'll be all right in terms of the presentation to the investors.
Yeah, and I'll say a couple of words on this too. So, a strong team, that's probably your most important thing. Regardless of what you're doing, you have to have a good team, because a good team will deliver. And, even with a weak product, you'll kind of figure it out. But if you don't have a strong team, you're not going to be able to do it. So how do you get a strong team? So that's the right question. Capital is not the issue, right? You're not going to get a team because you have money. Unless you get to, like VCs with $100 million that they're going to put into the company, the money's not going to make a difference. So what you're looking for is the passion of the person, right? So that's the key. So you have to find people that are very passionate about what you're doing, so that they will work through the problems, the inevitable problems that will come about as you try to build the company. So that's number one. Where do you find them? If you're at a university, you're probably in the most resource-rich environment you will ever be in for finding, founders and teammates for your company. So if you're in a lab, look up and around, and other people in your lab are probably going to be your strongest teammates, right? They might have different skill sets, but that's all right. That's how you build a good team. So look around, and if not in your lab, adjacent labs or somewhere on the university. So that's where you're going to find your great teams. So, but what the SDO program, what the Startup Development Officer program is really set to do, is to give you some help, with senior people that'll sit on your board or board of advisors. So you still have to find day-to-day people, locally, and people around you. But, we're helping to develop those teams with experience, with having these advisors and board of director people, the startup development officers help you. So, all right, Ria, next.
Um, Unfortunately, we've run out of time, so we won't be able to queue in any more questions. So, if there are questions that remained unanswered, all you need to do, email us at support@nset2.org, or email us back, so we could handle some of the questions for you offline. But before we conclude today's session, I'd like to thank Bob and, of course, Tony for joining us this afternoon. Do you guys have any last words before we close today's webinar?
Well, my only
Oh, I
comment,
think I'm good.
I think
Go ahead.
this will serve you in a lot of different ways, and I think just by developing it, you're going to have a whole different view of what you can do and what you can't do. So it's worth putting the hours in, just because of the learning process you're going to have and the understanding you're going to have, and as far as and be able to obtain the capital you need.
All right. So those who are still interested in, seeing whether their IP or their startups are market aligned for our SDOs to work on, especially if it's IP and you want to build the startup around it, The deadline to submit startups and IP is tomorrow, and all you need to do is go to our website and click on Submit IP or Submit Startup, and you should be able to find the form to provide the information for your IP or your startup to get ranked and scored by our corporate selection committee, who are very active in looking at technologies as well as startups to partner with. And just a reminder that our next webinar is on August 30th. That's Wednesday. And it's on angel investing. So, how to connect with angel investors about your technology and startup, the real risk reward profile of your opportunity. So, again, if you're registered for this webinar, you need not register again, but do look out for the email reminder about next week's webinar, and hopefully you can join us then. So, again, thank you to our speakers for joining us today, and thank you, everyone, for your questions. And hopefully, we see you again next week. The slides and recording will be available 24 to 48 hours. And again, check your emails. We should be able to send you the advice pretty soon. All right. Have a good afternoon, and thank you again.